The Federal National Mortgage Association, commonly known as Fannie Mae, is a government-sponsored enterprise and, since 1968, a publicly traded company. Founded in 1938 during the Great Depression as part of the New Deal, the corporation's purpose is to expand the secondary mortgage market by securitizing mortgages in the form of mortgage-backed securities, allowing lenders to reinvest their assets into more lending and in effect increasing the number of lenders in the mortgage market by reducing the reliance on locally based savings and loan associations. Its brother organization is the Federal Home Loan Mortgage Corporation, better known as Freddie Mac. History. The Great Depression wrought havoc on the U.S. housing market. By 1933, an estimated 20 to 25% of the nation's outstanding mortgage debt was in default. Fannie Mae was established in 1938 by amendments to the National Housing Act as part of Franklin Delano Roosevelt's New Deal. Originally chartered as the National Mortgage Association of Washington, the organization's explicit purpose was to provide local banks with federal money to finance home mortgages in an attempt to raise levels of home ownership and the availability of affordable housing. Fannie Mae created a liquid secondary mortgage market and thereby made it possible for banks and other loan originators to issue more housing loans, primarily by buying Federal Housing Administration insured mortgages. For the first 30 years following its inception, Fannie Mae held a monopoly over the secondary mortgage market. Other considerations may have motivated the New Deal focus on the housing market. About a third of the nation's unemployed were in the building trade, and the government had a vested interest in getting them back to work by giving them homes to build. Fannie Mae was acquired by the Housing and Home Finance Agency from the Federal Loan Agency as a constituent unit in 1950. In 1954, an amendment known as the Federal National Mortgage Association Charter Act made Fannie Mae into a mixed ownership corporation, meaning that federal government held the preferred stock while private investors held the common stock. In 1968, it converted to a privately held corporation to remove its activity and debt from the federal budget. In the 1968 change arising from the Housing and Urban Development Act of 1968, Fannie Mae's predecessor was split into the current Fannie Mae and the Government National Mortgage Association. Ginnie Mae, which remained a government organization, supports FHA-insured mortgages as well as Veterans Administration and Farmers Home Administration insured mortgages. As such, Ginnie Mae is the only home loan agency explicitly backed by the full faith and credit of the United States government. In 1970, the federal government authorized Fannie Mae to purchase conventional mortgages. The same year it went public on New York and Pacific exchanges, i.e., those not insured by the FHA, VA, or FMHA, and created the Federal Home Loan Mortgage Corporation, colloquially known as Freddie Mac, to compete with Fannie Mae and thus facilitate a more robust and efficient secondary mortgage market. In 1981, Fannie Mae issued its first mortgage pass-through and called it a mortgage-backed security. The Fannie Mae laws did not require the banks to hand out subprime loans in any way. Ginnie Mae had guaranteed the first mortgage pass-through security of an approved lender in 1968. In 1971, Freddie Mac issued its first mortgage pass-through, called a participation certificate, composed primarily of private mortgages. 1990s. In 1992, President George H.W. Bush signed the Housing and Community Development Act of 1992. The act amended the charter of Fannie Mae and Freddie Mac to reflect the Democratic Congress' view that the GSEs have an affirmative obligation to facilitate the financing of affordable housing for low and moderate-income families in a manner consistent with their overall public purposes, while maintaining a strong financial condition and a reasonable economic return. For the first time, the GSEs were required to meet affordable housing goals, set annually by the Department of Housing and Urban Development and approved by Congress. The initial annual goal for low-income and moderate-income mortgage purchases for each GSE was 30% of the total number of dwelling units financed by mortgage purchases and increased to 55% by 2007. In 1999, Fannie Mae came under pressure from the Clinton administration to expand mortgage loans to low and moderate-income borrowers by increasing the ratios of the loan portfolios in distressed inner-city areas designated in the Community Reinvestment Act of 1977. Additionally, institutions in the primary mortgage market pressed Fannie Mae to ease credit requirements on the mortgages it was willing to purchase, enabling them to make loans to subprime borrowers at interest rates higher than conventional loans. In 1999, the New York Times reported that with the corporation's move towards the subprime market, Fannie Mae is taking on significantly more risk, which may not pose any difficulties during flush economic times, but the government-subsidized corporation may run into trouble in an economic downturn, prompting a government rescue similar to that of the savings and loan industry in the 1980s, 2000s and 2000. Because of a reassessment of the housing market by HUD, anti-predatory lending rules were put into place that disallowed risky, high-cost loans from being credited toward affordable housing goals. In 2004, these rules were dropped and high-risk loans were again counted toward affordable housing goals. The intent was that Fannie Mae's enforcement of the underwriting standards they maintained for standard-conforming mortgages would also provide safe and stable means of lending to buyers who did not have prime credit. Daniel Mudd, then president and CEO of Fannie Mae, testified in 2007. Instead, the agency underwriting requirements drove business into the arms of the private mortgage industry, who marketed aggressive products without regard to future consequences. We also set conservative underwriting standards for loans we finance to ensure the home buyers can afford their loans over the long term. We sought to bring the standards we apply to the prime space to the subprime market with our industry partners, primarily to expand our services to underserved families. Unfortunately, Fannie Mae quality, safe loans in the subprime market did not become the standard, and the lending market moved away from us. Borrowers were offered a range of loans that led teaser rates, interest only, negative amortization and payment options, and low documentation requirements on top of floating rate loans. In early 2005, we began sounding our concerns about this lead risk lending. For example, Tom Lund, the head of our single-family mortgage business, publicly stated, "One of the things we don't feel good about right now as we look into this marketplace is more home buyers being put into programs that have more risk. Those products are for more sophisticated buyers. Does it make sense for borrowers to take on risk they may not be aware of? Are we setting them up for failure?" As a result, we gave up significant market share to our competitors. Alex Berenson of the New York Times reported in 2003 that Fannie Mae's risk is much larger than is commonly held. Nassim Taleb wrote in The Black Swan, "The government-sponsored institution Fannie Mae, when I look at its risks, seems to be sitting on a barrel of dynamite, vulnerable to the slightest hiccup." but not to worry. The large staff of scientists deemed these events unlikely. On January 26, 2005, the Federal Housing Enterprise Regulatory Reform Act of 2005 was first introduced in the Senate by Sen. Chuck Hagel. The Senate legislation was an effort to reform the existing GSE regulatory structure in light of the recent accounting problems and questionable management actions leading to considerable income restatements by the GSEs. After being reported favorably by the Senate's Committee on Banking, Housing, and Urban Affairs in July 2005, the bill was never considered by the full Senate for a vote. Sen. John McCain's decision to become a co-sponsor of S-190 almost a year later in 2006 was the last action taken regarding Sen. Hagel's bill in spite of developments since clearing the Senate committee. Sen. McCain pointed out that Fannie Mae's regulator reported that profits were illusions deliberately and systematically created by the company's senior management in his floor statement giving support to S-190. At the same time, the House also introduced similar legislation, the Federal Housing Finance Reform Act of 2005. In the spring of 2005, the House Financial Services Committee had crafted changes and produced a committee report by July 2005 to the legislation. It was passed by the House in October in spite of President Bush's statement of policy opposed to the House version, which stated, "The regulatory regime envisioned by H.R. 1461 is considerably weaker than that which governs other large complex financial institutions." The legislation met with opposition from both Democrats and Republicans at the point, and the Senate never took up the House-passed version for consideration after that. Following the mission to meet federal housing and urban development housing goals, GSEs such as Fannie Mae, Freddie Mac and the Federal Home Loan Banks had striven to improve home ownership of low and middle-income families, underserved areas, and generally through special affordable methods such as the ability to obtain a 30-year fixed-rate mortgage with a low down payment, and the continuous availability of mortgage credit under a wide range of economic conditions. Quote, "Then in 2003-2004, the subprime mortgage crisis began. The market shifted away from regulated GSEs and radically toward mortgage-backed securities issued by unregulated private label securitization conduits, typically operated by investment banks. As mortgage originators began to distribute more and more of their loans through private label MBSs, GSEs lost the ability to monitor and control mortgage originators. Competition between the GSEs and private securitizers for loans further undermined GSEs' power and strengthened mortgage originators. This contributed to a decline in underwriting standards and was a major cause of the financial crisis. Investment bank securitizers were more willing to securitize risky loans because they generally retained minimal risk, whereas the GSEs guaranteed the performance of their MBSs. Private securitizers generally did not, and might only retain a thin slice of risk. Often, banks would offload this risk to insurance companies or other counterparties through credit default swaps, making their actual risk exposures extremely difficult for investors and creditors to discern. The shift toward riskier mortgages and private label MBS distribution occurred as financial institutions sought to maintain earnings levels that had been elevated during 2001 to 2003 by an unprecedented refinancing boom due to historically low interest rates. Earnings depended on volume, so maintaining elevated earnings levels necessitated expanding the borrower pool used using lower underwriting standards and new products that the GSEs would not securitize. Thus, the shift away from GSE securitization to private label securitization also corresponded with a shift in mortgage product type, from traditional amortizing fixed-rate mortgages to non-traditional, structurally riskier, non-amortizing, adjustable-rate mortgages, and in the start of a sharp deterioration in mortgage underwriting standards. The growth of however, forced the GSEs to lower their underwriting standards in an attempt to reclaim lost market share to please the private shareholders. Shareholder pressure pushed the GSEs into competition with for market share, and the GSEs loosened their guarantee business underwriting standards in order to compete. In contrast, the wholly public FHA, Fannie Mae maintained their underwriting standards and instead ceded market share. The growth of private label securitization and lack of regulation in this part of the market resulted in the oversupply of underpriced housing finance that led, in 2006, to an increasing number of borrowers, often with poor credit, who were unable to pay the mortgages, particularly with adjustable-rate mortgages, caused a precipitous increase in home foreclosures. As a result, home prices declined as increasing foreclosures added to the already large inventory of homes, and stricter lending standards made it more and more difficult for borrowers to get mortgages. This depreciation in home prices led to growing losses for the GSEs, which backed the majority of U.S. mortgages. In July 2008, the government attempted to ease market fears by reiterating the view that Fannie Mae and Freddie Mac play a central role in the U.S. housing finance system. The U.S. Treasury Department and the Federal Reserve took steps to bolster confidence in the corporations, including granting both corporations access to Federal Reserve low-interest loans and removing the prohibition on the Treasury Department to purchase the GSE's stock. Despite these efforts, by August 2008, shares of both Fannie Mae and Freddie Mac had tumbled more than 90% from the one-year prior levels. On October 21, 2010, FHFA estimates revealed that the bailout of Freddie Mac and Fannie Mae will likely cost taxpayers $224 minus $360 billion in total, with over $150 billion already provided. 2008 Crisis and Conservatorship. On July 11, 2008, The New York Times reported that U.S. government officials were considering a plan for the U.S. government to take over Fannie Mae and/or Freddie Mac should the financial situations worsen due to the U.S. housing crisis. Fannie Mae and smaller Freddie Mac owned or guaranteed a massive proportion of all home loans in the United States, and so were especially hard hit by the slump. The government officials also stated that the government had also considered calling for explicit government guarantee through legislation of $5 trillion on debt owned or guaranteed by the two companies. Fannie stock plunged. Some worried that Fannie lacked capital and might go bankrupt. Others worried about a government seizure. U.S. Treasury Secretary Henry M. Paulson as well as the White House went on the air to defend the financial soundness of Fannie Mae, in a last-ditch effort to prevent a total financial panic. Fannie and Freddie underpinned the whole U.S. mortgage market. As recently as 2008, Fannie Mae and the Federal Home Loan Mortgage Corporation had owned or guaranteed about half of the U.S.'s $12 trillion mortgage market. If they were to collapse, mortgages would be harder to obtain and much more expensive. Fannie and Freddie bonds were owned by everyone from the Chinese government, to money market funds, to the retirement funds of hundreds of millions of people. If they went bankrupt, there would be mass upheaval on a global scale. The administration PR effort was not enough by itself to save the GSEs. The government directive to purchase bad loans from private banks, in order to prevent these banks from failing, as well as the 20 top banks falsely classifying loans as AAA, caused instability. Paulson's plan was to go in swiftly and seize the two GSEs, rather than provide loans as he did for AIG and the major banks. He told President Bush that the first sound they hear will be the heads hitting the floor, in a reference to the French Revolution. The major banks have since been sued by the feds for a sum of $200 million, and some of the major banks have already settled. In addition, a lawsuit has been filed against the federal government by the shareholders of Fannie Mae and Freddie Mac, for creating an environment by which Fannie and Freddie would be unable to meet the financial obligations, forcing the executive management to sign over the companies to the conservator by, and c. the gross violation of the taking clause. On September 7, 2008, James Lockhart, director of the Federal Housing Finance Agency, announced that Fannie Mae and Freddie Mac were being placed into conservatorship of the FHFA. The action was one of the most sweeping government interventions in private financial markets in decades. Lockhart also dismissed the firm's chief executive officers and boards of directors, and caused the issuance to the Treasury new senior preferred stock and common stock warrants amounting to 79.9% of each GSE. The value of the common stock and preferred stock to pre-conservatorship holders was greatly diminished by the suspension of future dividends on previously outstanding stock. In the effort to maintain the value of company debt and of mortgage-backed securities, FHFA stated that there are no plans to liquidate the company. The authority of the U.S. Treasury to advance funds for the purpose of stabilizing Fannie Mae or Freddie Mac is limited only by the amount of debt that the entire federal government is permitted by law to commit to. The July 30, 2008 law enabling expanded regulatory authority over Fannie Mae and Freddie Mac increased the national debt ceiling $800 billion to a total of $10.7 trillion in anticipation of the potential need for the Treasury to have the flexibility to support the Federal Home Loan Banks. 2010 delisting. On June 16, 2010, Fannie Mae and Freddie Mac announced the stocks would be delisted from the NYSE. The Federal Housing Finance Agency directed the delisting after Fannie's stock traded below $1 a share for over 30 days. Since then, the stocks have continued to trade on the over-the-counter bulletin board. 2013 $59.39 billion dividend. In May 2013, Fannie Mae announced that it is going to pay a dividend of $59.4 billion to the United States Treasury. 2014 $134.5 billion dividend paid. $116 billion received from Treasury. $134 billion paid to Treasury. Fannie Mae 2014 financial results enabled them to pay $20.6 billion in dividends to Treasury for the year, resulting in a cumulative total of $134.5 billion in dividends through December 31, 2014, approximately $18 billion more than Fannie Mae received in support. As of March 31, 2015, Fannie Mae expects to have paid a total of $136.4 billion in payments to Treasury.